European stocks retreating Tuesday on more worries about China. Jasper Lawler, market analyst at CMC Markets, joins me from London. Jasper, we did see some disappointing manufacturing data from China weighing on the markets globally, really. Why are we seeing this kind of sell-off in Europe today? Why hasn't this worry about China been priced into the markets yet?
Well, it's really deja vu on the first day of September. It's looking very much like August, because it is just China at the center of attention again. We'd had a strong bounce off the lows in Europe and in the US in the hopes that Chinese regulators had got this under control with a bit of monetary easing over in China. We'd also had some Fed speakers offering some comforting words that perhaps a September rate hike wasn't on the cards. And so last week we got a strong bounce off the lows, but we're seeing selling again today. That does correspond with having made up about half of the losses in the FTSE 100, for example, since that China devaluation 3 weeks ago. And it looks like investors just don't have the appetite to carry stocks much higher.
So are the jitters solely about China, or are there some concerns about what's happening fundamentally in Europe? The manufacturing sector in some countries there are weak as well.
Absolutely. It's a global growth slowdown concern, and that effect has global implications. And Europe's data, we're still seeing expansion here, but it's a bit softer than was expected. And so that is certainly weighing on the sentiment. And there's a feeling that China's slowdown can have a bearing on Europe's economy. It's a big export destination for us, and the slowdown there is certainly not going to help prospects for growth over here. And so the two very much feed into one another.
So what do you think is it going to take for European markets to stabilize and some of the volatility to leave the markets?
Well, the big one that we have in Europe this week is obviously the meeting from the European Central Bank. Now, they have the capacity to really change the course of markets were they to introduce some perhaps additional purchases to what's already under their quantitative easing program, or perhaps even just to extend the length of the program. It's supposed to end in September next year. They could extend that by a few months. That would certainly offer some comfort that at least the central bank is there purchasing in the market and theoretically putting some floor under the market. But to be quite honest with you, that floor has not seemed so apparent in the last month. There was a hope that European stocks could just go up and up. At one point last month, German stock index, after the DAX index, after having been up 25% on the year, was actually flat on the year. So maybe there's only so much the European Central Bank can do, but certainly more of that central bank intervention would be a game changer.
Jasper, in this trading environment right now, are there certain areas of the stock market that are safer than others in terms of sectors or countries?
Well, I think when you're talking about the US, one of the more preferable areas has just been healthcare. It's traditionally a fairly safe sector anyway. That's slightly changed, obviously, with the prominence of biotechs. But there's a lot of M&A taking place. So when markets are flat or more recently down, looking for M&A opportunities within the market, which has been particularly concentrated within healthcare, makes a lot of sense. Over here in the UK, utilities, there's some signs that the regulators are not clamping down on these big utility companies as much as they were when energy prices were so high and everyone was worried about their gas bills. And so, again, utilities are traditionally fairly safe area of the market, somewhat dependent on when interest rates are likely to rise because they're very heavily indebted typically. But when we see oil prices dip down to $40 per barrel, probably tells us that the Bank of England isn't set to move on interest rates anytime soon. And so utilities, again, a safer area in the context of a sea of red.
And on that sea of red theory there, Jasper, do you expect that the markets will retest lows and perhaps break through?
That's my base case scenario, is that we probably got more downside to come. I think this was a natural bounce after such sharp declines. Things never go down in a straight line. And I think that probably we still are not going to quite, just one or two interest rate cuts from China are not going to ease concerns that globally that is the trend. It's a very slow recovery in the US, one of the slowest on record after recession. Europe's barely out of recession. And so that's going to gradually weigh on stock market fundamentals at a time when some of the leading central banks, the Fed namely, are looking to start tightening policy again. So I think those factors are going to drive us lower before we can get higher again.
Jasper Lawler of CMC Markets, thanks for your time.
Thank you.
I'm Rhonda Schaffler for The Street.